The market feels like it's all over the place, doesn't it? One day tech stocks are soaring, the next they're overvalued. Inflation's cooling, but interest rates are still high. If you're feeling stuck or unsure about where to put your money, you're not alone. But here's the good news. I've got a cheat sheet. The Q3 2024 13F filings just dropped, and they show exactly what the smartest investors like Warren Buffett, Bill Ackman, and Michael Burry are doing right now. These filings revealed their biggest buys, boldest bets, and biggest sales. Today, I'll break down their most interesting moves and what they mean for investors like you. From Buffett's surprising sell-off to Ackman's bold bet and Burry doubling down on overseas tech, there's a lot to unpack. Before we look into details of who's buying what, let's quickly get on the same page about these 13F filings. This won't feel like homework. This part is key to making sense of everything that follows. So what are 13Fs? In the simplest terms, they're quarterly reports that big institutional investors, like hedge funds and Warren Buffett's Berkshire Hathaway, are required to file with the SEC. Think of it as a snapshot of what the smart money was doing last quarter. But here's the catch. There's a 45-day delay. So while these filings show us what they were buying or selling last quarter, the market could have moved quite a bit since then. Does this make 13Fs useless? Absolutely not. They're incredibly valuable for spotting long-term trends, understanding investor psychology, and even finding potential opportunities that might still be worth considering. One more thing, not every move in a 13F is a buy now signal. These investors have different goals, risk tolerances, and timelines than most of us. That's why it's so important to treat this information as a learning tool, not a treasure map. With that in mind, let's get into the specifics, starting with the man himself, Warren Buffett. His Q3 moves are a masterclass in rebalancing a portfolio, so let's break it down. This quarter, some of his decisions raised eyebrows, especially his significant reduction in one of his favorite holdings, Apple. Buffett trimmed his Apple position by 25%, which might surprise some given his long-standing admiration for the tech giant. For years, Apple has been the crown jewel of Berkshire Hathaway's portfolio, making up a massive chunk of its holdings. But Apple's valuation has soared, with its price-to-earnings ratio climbing to 37, far higher than the 12 it was at when Buffett started buying. Simply put, the stock has gotten expensive. That said, this isn't the end of Buffett's Apple love story. He's still holding on to 300 million shares, so it's more like getting his profits cashed in. Another notable reduction was in Bank of America, where Buffett trimmed 22.77% of his position. With interest rates climbing and growing concerns about bank earnings, this appears to be a move to reduce exposure to a sector facing headwinds. On the buying side, Buffett's moves were just as interesting. He added new positions in Domino's Pizza and Pool Corp. While Domino's might not seem like the kind of stock to grab headlines, its delivery-focused business model and pricing power make it a standout in uncertain economic times. Consumers turn to comfort food during downturns, and Buffett's bet on Domino's aligns with this trend. Pool Corp, on the other hand, plays into the infrastructure space. As a market leader in pool supplies and maintenance, it's a business built on consistent cash flow, which is exactly what Buffett loves. So, what's the strategy here? Buffett is doing what he does best, rebalancing his portfolio. He has trimmed overvalued positions like Apple and reallocated to companies with strong fundamentals and predictable cash flows. He's managing risk while ensuring his portfolio remains grounded in value. The big takeaway here, one lesson stands out. First, don't get too attached to any stock no matter how much you love it. If a company's valuation gets too high, it might be time to take some profits, just as Buffett did with Apple. Next up, I'll show you Bill Ackman's portfolio, whose bold bets this quarter couldn't be more different from Buffett's cautious rebalancing. This quarter, Ackman made some attention-grabbing moves, including a massive bet on Nike, a significant increase in Brookfield Corporation, and a surprising new position in Seaport Entertainment Group. Unlike Warren Buffett's cautious rebalancing, Ackman's strategy this quarter was all about seizing opportunities in undervalued and potentially transformative businesses. Let's start with Nike, where Ackman added a staggering 435% to his position. This isn't a small bet. Nike now makes up 11.15% of his portfolio. So what's the story here? Nike has faced challenges recently, with a 10% decline in sales during the last quarter and ongoing struggles in key markets like China. But Ackman seems to be focusing on the long-term position of the brand. Nike's pivot to direct-to-consumer model, while criticized in the short term, could eventually boost its margins and strengthen the company's control over its supply chain. Ackman has a history of spotting turnarounds. His 2016 investment in Chipotle during its PR crisis is a textbook example, and his Nike play seems to follow a similar pattern. He's betting on brand loyalty and a strong recovery. Next, there's Brookfield Corporation, where Ackman increased his position by 377.5%. Brookfield is a major player in infrastructure and asset management, sectors that are becoming increasingly attractive as interest rates stabilize. Ackman appears to see Brookfield as a long-term winner, benefiting from global demand for infrastructure development and real estate expertise. This move aligns with his knack for finding value in businesses with large-scale growth potential. He also added a smaller new position in Seaport Entertainment Group, a less-known company focused on leisure and entertainment assets. While this might seem like a niche bet, it's consistent with Ackman's history of picking companies that thrive on unique business models. But Ackman wasn't just buying. He's trimmed his stakes in several other holdings, including Hilton Worldwide Holdings, which saw a 17.67% reduction, and Restaurant Brands International, where he shaved off 0.6%. These reductions seem more about rebalancing than signaling a loss of confidence, as both companies remain significant parts of his portfolio. Next, I'll show you what Michael Burry has done to his portfolio, once again betting against the grain like he did in 2008 and was proved right. Famously known by the name The Big Short, Burry has built a reputation as an opposed investor, someone who spots opportunities in places most wouldn't dare look. His Q3 2024 moves stayed true to form, with significant activity in Chinese tech stocks, some bold additions to niche holdings, and notable reductions in underperforming positions. If there's one takeaway from Burry's portfolio this quarter, it's that he's doubling down on undervalued assets, even when they're swimming against the tide. Let's start with his increased exposure to Chinese tech. Burry added 100% to his JD.com holdings, 66.67% to Baidu, and 29.03% to Alibaba. For context, these stocks have been hammered over the past year, with steep declines fueled by China's economic slowdown and ongoing regulatory uncertainty. Despite these challenges, Burry appears to be betting on the long-term importance of these companies within China's economy. JD, Baidu, and Alibaba are often called the crown jewels of Chinese tech, dominating their respective sectors. Burry believes their current valuations, much lower than their historic peaks, present a rare opportunity for outsized gains if and when the Chinese economy stabilizes. This isn't just a spur-of-the-moment decision either. Burry has held on to his Chinese tech position since late 2022, signaling a long-term commitment rather than a short-term trade. His additions this quarter suggest he sees even more upside potential now, despite the macro risks. It's a classic Burry move. Find value where others see chaos. He wasn't just active in Chinese tech. Burry also added 50% to his position in Shift4 Payments, a smaller fintech company focused on streamlining payment solutions for businesses. While not as high profile as his tech plays, this addition shows his broader interest in technology-driven growth opportunities. Additionally, he increased his stake in Molina Healthcare by 22.3%, signaling confidence in the stability of the healthcare sector. On the flip side, Burry significantly reduced two positions. He cut his holdings in The RealReal, a luxury consignment retailer, by 50%, and in American Coastal Insurance by 60.3%. These reductions could indicate a significant shift in focus away from less predictable or underperforming assets. Next, I will show you Mohnish Pabrai's portfolio, which revolves around deep value plays, especially in coal and shipping. Like the previous big money, Mohnish Pabrai is very much into deep value investing styles. His Q3 2024 moves are no exception, with a continued focus on coal stocks, an industry many investors shy away from, as well as a surprising new position in shipping. If you've ever wondered how a contrarian investor spots hidden value, Pabrai's portfolio is a fascinating case study. Coal stocks were the best performers in Pabrai's Q3 strategy. He massively increased his position in Consol Energy, adding 345.95% to make it a solid 32.66% of his portfolio. He also increased his stakes in Warrior Met Coal by 48.12% and Alpha Metallurgical Resources by 6.85%. These companies are focused on metallurgical coal, a key component in steel production, which remains essential for infrastructure and industrial growth worldwide. While the world is transitioning away from thermal coal for energy, Pabrai is clearly betting that the met coal will remain a critical resource for years to come. However, it wasn't all additions in the coal space. Pabrai made a drastic reduction in his position in Arch Resources, cutting it by 92.1%. This may reflect a strategic shift towards companies with stronger fundamentals or better pricing power within the met coal sector. He appears to be doubling down on his highest conviction bets by reallocating heavily into Consol and Warrior Met Coal. Beyond coal, Pabrai took a new position in Danos Corp, a shipping company which now makes up 1.64% of his portfolio. Shipping is another industry that often flies under the radar, but it has experienced a resurgence in profitability thanks to ongoing global trade and supply chain constraints. Danos, in particular, specializes in container shipping and has a strong history of generating free cash flow. Now that we've unpacked the moves of Buffett, Ackman, Burry, and Pabrai, let's take a step back and look at the bigger picture. What do these moves tell us about the broader market trends, and are there any hidden gems that deserve a closer look? By connecting the dots across these portfolios, I've uncovered key themes and insights that can help shape your investing strategy. One clear pattern this quarter is a focus on rebalancing and caution. Buffett and Ackman are both trimming positions in sectors that have seen significant overvaluation in recent years. Buffett's reduction in Apple, despite it being his flagship holding, underscores a fundamental principle of value investing. Don't fall in love with any stock, no matter how successful it's been. Similarly, Ackman's trims in Hilton Worldwide and restaurant brands show a measured approach, even as he doubles down on high-conviction plays like Nike and Brookfield. This highlights a broader trend of top investors prioritizing stability and cash flow while navigating an uncertain economic environment. Meanwhile, contrarian bets like both Burry and Pabrai are leaning into undervalued sectors that many would consider risky. Burry's heavy additions to Chinese tech stocks, despite ongoing regulatory and geopolitical challenges, reflect his belief in long-term recovery and growth in these crown jewel companies like Alibaba and JD. So, what does this all mean for you as a retail investor? First, it's clear that balance is key. Whether you're inspired by Buffett's cautious trimming or Burry's bold bets, the takeaway is the same. Every portfolio needs to adapt to changing conditions. Second, don't shy away from sectors that others might dismiss. Coal, shipping, and Chinese tech might not be the obvious choices, but as Pabrai and Burry show, they can be sources of tremendous value if approached strategically. Feds think the economy is strong. Click the video on the screen to crack the case on how they are lying to us.